If you're new to investing, the stock market can feel like an overwhelming wall of noise. You open YouTube, scroll through social media, or turn on the financial news, and you are immediately hit with thousands of conflicting opinions. Buy this tech stock before it's too late. Sell everything. The crash is coming. This penny stock is the next Amazon. Everyone seems to have a different secret strategy. Some people talk about day trading and watching charts for 8 hours a day. Others tell you to buy gold and hide it under your mattress. If you're a beginner, it's easy to feel like you're missing a piece of the puzzle, like there's a hidden room where the real investors make all the money. But here's the truth that the hype merchants won't tell you. Most beginners don't lose money because the stock market itself is a dangerous place. They lose money because they start the wrong way. They chase the latest hype. They buy random companies because of a headline they didn't fully read. They try to trade and time the market before they even understand the basic mechanics of how a business generates value. Investing doesn't need to be a complex, high-stress gamble. In this video, I'm going to show you the simple, step-by-step blueprint that beginners should actually follow to start. No hype, no moonshots, just the fundamental mechanics that actually build wealth over time. Before you even think about buying your first share of stock, you need a basic financial foundation. This is the floor of your investment house. If you build on sand, the first storm will knock it down. Because here is a mechanical reality. Investing money you might need for rent next month is one of the fastest ways to panic and lose everything. When you invest scared money, you make scared decisions. So, step one is simple, but non-negotiable. You must have financial stability first. This usually means 3 things. An emergency fund, at least 3 to 6 months of living expenses sitting in a boring savings account. No high-interest debt. If you are paying 20% interest on a credit card, no stock market return is going to outrun that. You are investing in the bank's profit, not your own. Capital you won't need immediately. This is money you can leave alone for at least 5 to 10 years. The stock market goes up over the long term, but in the short term, it is volatile. It breathes. Sometimes markets drop 10% in a week, sometimes 20% in a month. If all your net worth is in the market and you suddenly lose your job or have a medical bill, fear will push you to sell at the absolute worst moment, at the bottom. Investing works best when you can ignore the price today because you don't need the cash today. Once your foundation is stable, you have the structural permission to move to step 2. A lot of beginners look at stocks and see flashing green and red numbers on a screen. They see a ticker symbol like Apple or Tesla as if it's a sports score. But a stock is actually something much more grounded in reality. When you buy a stock, you are buying ownership in a real-world business. If you buy a share of Apple, you are a part owner of the iPhone. If you buy a share of Amazon, you own a piece of the largest logistics and cloud computing machine on the planet. This means you own a claim on their future profits and their physical assets. This is a massive mindset shift. Investing isn't just about betting on price movements. It's about owning productive engines. When a company sells more products, expands into new countries, or invents a new technology that makes them more profitable, the value of your slice of that pie rises. You aren't just buying a stock. You are hiring a CEO and thousands of employees to work for you while you sleep. Once you realize that you are an owner, the short-term zigzags of the price matter much less than the long-term health of the business. One of the most dangerous traps for a beginner is the urge to pick the next superstar stock. We all hear the stories of someone who bought Bitcoin in 2011 or Tesla in 2012 and became a millionaire overnight. Those stories are seductive, but they are outliers. The truth is, consistently picking winning individual companies is extremely difficult. Even professional fund managers, people with PhDs and supercomputers, struggle to beat the market average over 10 years. For a beginner, putting all your capital into one or two companies is a high-risk gamble. If that company has a scandal, a bad product launch, or gets disrupted by AI, your entire portfolio can be wiped out. This is why diversification is your best friend. Diversification means spreading your investment across hundreds of companies so that no single failure can ruin you. The easiest way to do this is through an ETF, exchange-traded fund. Think of an ETF as a basket. Instead of buying one apple, you buy a basket that contains every type of fruit in the grocery store. For example, an S&P 500 ETF holds shares of the 500 largest, most successful companies in America. When you buy one share of that ETF, you are instantly diversified across tech, healthcare, energy, and retail. This approach is the structural blueprint for long-term success because it allows you to bet on the entire economy rather than a single CEO's luck. Once you have your basket, the next step is consistency. Most people fail because they try to time the market. They wait for a dip to buy, or they get scared when things are too high and wait for a crash. The problem is that no one, not even the experts, knows when the bottom or the top is. The mechanical solution to this is dollar-cost averaging. This means you invest the exact same amount of money on a regular schedule, every month or every paycheck, regardless of whether the market is up or down. When the market is high, your money buys fewer shares. When the market is low and everyone else is panicking, your money buys more shares. Over time, this averages out your cost. It removes the emotional pressure of having to be right. It turns investing from an emotional decision into a mechanical habit. Historically, the boring investor who never misses a month beats the smart investor who tries to guess the next move. The most powerful force in the financial universe isn't a high-speed algorithm or a genius trade. It is time. When your investments grow and those gains generate their own gains, you trigger compounding. In the beginning, it feels painfully slow. If you invest $1,000 and it grows 10%, you have $1,100. It doesn't feel like a life-changing event. But in year 2, that 10% isn't just growing on your $1,000. It's growing on the $1,100. Over 10, 20, or 30 years, this curve turns vertical. This is why a 20-year-old who invests a little bit of money often ends up wealthier than a 40-year-old who invests a lot. But compounding has a tax. That tax is patience. There will be news cycles that say the end is near. There will be years where your portfolio goes nowhere. But long-term investors ignore the headlines and focus on the structure. They know that as long as humans are productive and companies are innovating, the engine will keep moving. You don't need to be a genius. You just need to be someone who can stay in the game long enough to let the math work. As you gain experience, the market will try to tempt you with advanced strategies. Options trading, short selling, leveraged products, crypto arbitrage. These are shiny objects designed to create fees for brokers. But for the vast majority of people, the most effective strategy is also the simplest. A diversified ETF portfolio. Low management costs, consistent contributions. extreme patience. Ironically, many people lose money not because their strategy was wrong, but because they tried to make it more sophisticated than it needed to be. They broke the engine by trying to tune it too much. Wealth creation is not about being active. It's about being positioned. Investing in the stock market doesn't require a crystal ball or a degree in finance. It requires discipline. It requires an understanding of what you are buying, not just numbers, but businesses. And it requires giving your investments the time they need to breathe. Start with your financial foundation. Move into diversified assets, stay consistent through the storms, and allow compounding to do the heavy lifting for you. Because in the long run, the market rewards endurance over prediction. The goal isn't just to have more numbers in a bank account. The goal is the sovereignty of time. We invest so that one day, our assets do the labor that we used to do. We move from the salary machine to being a sovereign owner. Once you understand that, you start seeing every dollar as a seed for your future freedom. If you want to keep breaking down how money and markets really work, simply, clearly, and structurally, subscribe. Let's keep fixing the mechanics together.